LIMRA found that most Americans have heard of annuities, but only 1 in 4 actually know what they are. And no wonder, they're not really taught in school, and Wall Street nor most financial advisors are motivated to tell you how they really work. Why is this the case? Because annuities don't generate the same fees or commissions as risk-based investments. So in this retirement income school lesson, let's break it down. What annuities really are, how the fees and rates really work, and why most retirees are choosing them in 2025. That way you can decide if annuities might be the safest and most reliable retirement income strategy that you never fully understood until now. If it's your first time here, I'm Dr. Amanda. Welcome to the Retirement Income School. This is your place to get financial education to help you protect your wealth and generate guaranteed income so you can retire financially relaxed. All right, let's dive right in. In this lesson, you're going to learn what annuities really are, why most people misunderstand them, how rates, fees, and income riders actually work. We're going to do a live fixed index annuity walkthrough with an income rider breakdown. And we're going to talk about why annuities are becoming a core part of retirement income planning for 2025 and beyond. Let's start with the simplest definition of an annuity, just in case you've heard what it is, but you actually don't know the definition. An annuity is simply a contract with an insurance company that provides a stream of guaranteed income, often for life, in exchange for a lump sum or a series of payments. So it's a contract with an insurance company where you give them either a series of payments or a lump sum, and then they turn it into a stream of income for you. And most of the time here at the Retirement Income School, I'm talking about lifetime income. So often this will be a stream of income that's guaranteed for life. And I'll break that down in this lesson. I often like to understand the history of things, and so for annuities, I want you to think about this. They date back all the way to ancient Rome, where citizens would make lump sum payments to receive a guaranteed annual income. This was a system known as Annua, so it dates back all the way to ancient Rome. And then in the US, annuities gained popularity during the Great Depression as a way to create financial security. Let's think about how Social Security is a monthly paycheck that you get in the form of an annuity. I always think it's interesting when people say, I don't believe in annuities, or I don't think they're a good thing. And, we could just say, well, why don't you give me your Social Security check then? Because it wouldn't make sense to be anti-annuity if you are receiving Social Security or plan to, because it's a version of an annuity. And if we think about annuities today, they've evolved into modern financial tools that are designed to provide guaranteed income. This really protects you against market risk and helps retirees avoid outliving their savings. So you've heard me talk in other lessons about longevity risk and how our life expectancy has increased. So a big concern for people who are saving for retirement is that you might run out of money. And that is a really horrible feeling. So annuities protect you against this risk, and they also protect your wealth from market downturns, especially in that important time. I've talked in other lessons about how to build your income floor and the importance of making sure that all of your needs are met financially so that you can retire with peace of mind. So annuities are a part of building your income floor. When you combine these with Social Security income, potentially a pension if you have one, or even whole life insurance income that you could take through distributions of loans from your whole life cash value, this is going to create your income floor. So an annuity is a strategy we use here to fill the gaps in your retirement income, and this matters because you want to make sure that income floor is met. Why do we like annuities? What are the goals of annuities? An annuity provides guaranteed income that turns savings into reliable cash flow. So a lot of times we think about the accumulation part of retirement, where we're building, accumulating, watching it grow over our years that we're saving in order to have enough money for retirement. An annuity is a way to turn that accumulated savings into a lifetime income. Another goal that's met with annuities is the risk removal. So it protects against market uncertainty and also provides that income floor like we just talked about. You create clarity in your retirement plan. Keep in mind that annuities are not about beating the market. You wouldn't want to purchase an annuity if you're looking for huge gains in the market. Annuities are much more about protecting your assets and using what you've saved to create a lifetime guaranteed income. Sometimes you might buy what's called a MYGA, a multi-year guaranteed annuity. This is much more like a CD, but it protects your income, and the interest grows tax deferred, and you don't pay on that interest until you decide to withdraw, and your principal is protected. And often the rates of multi-year guaranteed annuities are higher than CDs. So a lot of people like those for that. Remember, when you're thinking about purchasing an annuity, you want to think, what is my goal for the annuity? Is it that I want a couple years of earned interest that's tax deferred, and then I want to be able to remove the principal? Then you might be looking for a MYGA. Is it that you want to take your lump sum savings, roll it over from a 401k or an IRA into an annuity so that you have that guaranteed lifetime income? Well, then you're going to be looking for a fixed index annuity with a guaranteed income rider. And so there are different types of annuities. This is where education is really important, and you want to be thinking about, what is the purpose of the annuity? What do you want that money to accomplish? And that's why you want to talk to me or somebody who's experienced in selling annuities so that they can help you decide what's the best fit for your unique situation. Why are annuities such a hot topic in 2025? Well, they have higher rates. So annuities are paying more than they have in years, creating better income opportunities for today's retirees. There's also a lot of market uncertainty. So increasing volatility has many retirees seeking shelter from unpredictable market swings. We all know that there's been a lot of market fluctuation, and in these times, especially when you're moving into retirement, you do not want to have a big loss the years before retirement, the years you're in retirement, or soon after you've retired, because that could really deplete your retirement income, or at least make it unpredictable. So an annuity can solve this problem, and that's why a lot more retirees are interested in understanding how an annuity could be a good fit for them. There's also that desire for certainty. Today's retirees prefer guaranteed outcomes over speculative investments. One thing to consider is your own risk tolerance. Some people have a much higher risk tolerance, and some people also have a larger portfolio that they can put at risk. This is going to vary for each person, dependent on your circumstances and risk tolerance. Interestingly, annuities have had record growth. So annuity sales reached $385 billion in 2023 with continued growth through 2025. I heard on a webinar I was on this morning that between 2020 and 2024, annuities have grown by 98%. So there's a lot of interest in annuities. There's also a lot of misinformation, and sometimes they have a bad reputation. So that's why it's really important for you to educate yourself and know what you might be missing out on just by hearing somebody say, oh, annuities are bad, or I don't like annuities because of this. Typically when someone says that to me, I say, okay, tell me what you know about annuities. And they really don't know much. So make sure that you are understanding the basics of annuities. That's why I'm here for you, teaching you about annuities on a regular basis. Now let's understand annuity rates. There are fixed annuities. These offer a steady guaranteed rate similar to a CD, but typically higher. So those were the MYGAs I was talking about, multi-year guaranteed annuities. We've also got fixed index annuities. These provide upside potential based on index performance with no downside risk. And these are based on contractual guarantees. So the way this works is that your performance of your annuity is tied to an index like the S&P 500, but your money's not invested in the stock market. So they credit your annuity with participation rates or cap rates. Let's say that you have a cap rate of 7%, but the S&P 500 goes up by 10% that year. Well, you're capped at 7, so you're going to get credited 7%. But let's say the S&P goes down by 10%, well, you're going to get 0%. So you can't lose, but you can gain. For participation rates, let's say that you have a 100% participation rate. Well, if the index goes up by 7%, you're going to get 7%. And that's why retirees really like fixed index annuities, because money is protected and your rates are going to be guaranteed contractually, so you know what you're getting into from the start. This is obviously very dissimilar from your money being invested in the market where you don't have protection. And If you're 30 years old and you're invested in the market and there's a dramatic swing, that's okay. You have time to recover. When you're at retirement age or moving into retirement, it's a lot scarier to be subject to market volatility. So that is where fixed index annuities offer the upside potential without downside risk. There are also annuities that have income riders, and I talk about those a lot here because when you're thinking about retirement income, you want to grow a benefit base for future guaranteed lifetime income payments. So this is an annuity contract where you add an income rider, and this guarantees you income for life no matter how long you live. All of these options are going to help you protect your principal while safely growing your money. So how do fixed index annuities work? They are index linked, so they're connected to the market index performance. One could be the S&P 500. There are several to choose from, and different companies have different configurations of portfolios for various indices. There's principal security. So you're not directly invested in the market. This protects your savings. You earn via cap rates and participation rates or spreads. And there's downside protection. A 0% floor means no market losses affect your principal. So you're protected from market losses. Now let's dive into annuity fees. In terms of thinking about different annuity types, you've got base fees and rider fees. For fixed annuities, there's going to be 0 base fees, and you might have riders that are optional. So there may be fees there, but there doesn't have to be. So you could have an annuity with no fees. There's fixed index, there's no base fees there. Same thing, you have optional riders. So the only annuity type that absolutely will have a fee is if you choose an income rider. So if you say, I want an annuity with guaranteed lifetime income, then you're going to pay a fee for that income rider. Right now in 2025, they're around 0.95 to 1.25% annually. Now, what's important to think about for annuity fees is that many annuities are fee-free unless you add the optional riders. But when you do add the optional riders, you're paying for guaranteed lifetime income and protecting yourself from market performance. So let's play this out in an example. You've probably heard of the 4% safe withdrawal rate. They're actually now saying it's closer to 3%. But let's say that you have $500K saved up in your 401k and you decide I'm going to take out 4% per year safely, and I'm going to hope that it lasts me for the next 25 to 30 years while I'm in retirement. Now, just for the sake of comparison of an annuity that I'll walk you through here in a few minutes, let's say that you have a 401k or an IRA that you're going to pull 4% from, and you have $200,000. So you've got $200,000 times 4%. They're saying now 3%, but we're just going to say 4%. That's $8,000 per year that you can pull from that safely in order to have it last your lifetime potentially. Now, that's if there are no massive downturns in the market while you're in retirement. Of course, you could also potentially gain and you might be able to take out more, but you can't guarantee that. So that is $666.67 per month. And we're going to compare that to an annuity that we build in this lesson that you can look at. So I want you to be thinking about this fee here, this income rider fee, giving you lifetime protection in the annuity. And we'll bring this up again so that you can understand why I'm pointing this out to you. Now let's compare fixed index annuities versus market investments. So think about your market portfolio. You are charged a fee, often 1% to 2% in advisor and fund fees. There are no guarantees. You've got sequence of returns risk, potential for higher growth, like I just said. It does require active management, and you have no longevity risk protection. So that's if you have a market-based portfolio. If you have an annuity, many of them are fee-free, or you pay the rider fee, like we just talked about, the 0.95 to 1.25% per year. But that gives you contractual guarantees. You have no sequence of returns risks. You have limited upside potential, so you can have some gain, but it's not going to be in those double-digit numbers. Yet, it is a set it and forget it approach. You're not looking at it all the time. You're not worrying about it. You're setting up the annuity. It's a contractual guarantee. You know exactly what you're going to get. And this also gives you longevity risk protection because you don't have to worry, should I take out this percent each year? What if the market goes down? What if I live to 100 and I need income every single month for the rest of my life? So with annuities, you're paying for long-term certainty rather than market volatility. And I also want to point out that when you're paying that 1 to 2% in advisor fees, you're paying that whether you win or lose. In an annuity, you're paying it and you're getting in exchange a guaranteed lifetime income. So that's why that fee exists. All right, so this is my annuity software, and what we do is we put your information in. So I set this up as Sam and Sandy for a walkthrough. I put that they live in Colorado because that's where I'm from, and that they're putting in $200,000. This could be from a traditional IRA, 401k, TSP, all kinds of options here, but let's just put any funding for now. And we want no income reduction, so no chance of loss of the income over time. I put that they're 60 years old and that they want joint lifetime income. Now, if they wanted single income, we would just change this to the person who owns the contract, so Sam, who's male, or we could change it to female if Sam was female, or we add joint. Now, when you have a meeting with me, of course, we'll customize all of this to your situation. But I just wanted to show you a comparison of what we were talking about before. If a couple was to draw on $200,000 of retirement income, remember we said that at that 4%, they could draw $8,000 per year. Here with an annuity, they are 60 years old. And if they started pulling immediately, they'd have $1,083 per month. That's already more than the 4% that they could safely withdraw from their qualified retirement plan. Remember, we said it was $666 a month, so that's much higher here. But let's say in this case that they're going to start drawing income at 65. So they're going to sit and wait 5 years. They want to defer this annuity because they've got other income still coming in. They haven't retired. Perhaps they're bridging the gap, let's say it's age 62 with Social Security income, or maybe they have a pension, or maybe they just decide they want to retire at 65. There are a whole bunch of different scenarios, as you know. So we've got lifetime income. It's coming in monthly. This is joint, meaning that if Sam passes first, then the second person on the joint annuity would keep receiving this for the rest of their lifetime. For this couple, I put them both as age 60, and the annuity is always going to be based on the youngest person. So let's say that I dramatically change this person's age to 45. Watch how this income changes by a lot. Why would that be the case? It's because now if the income's turned on at age 65, then the spouse is only 50, so they potentially are paying that income for a lot longer. So that's why this number would go down. But just for the sake of comparison, we're going to keep this person at 60, and they're going to defer for 5 years, and here is the monthly income they're going to get, or if you want to look at it annually, they would get $20,850. Now that's versus $8,000 that they were going to get in their qualified plan if they withdrew 4%. And then let's just break this down by looking at the illustration from Corebridge. This is the carrier that showed the highest income. So let's just illustrate this and take a quick look. So right now they're showing that they would be able to withdraw 6.95% for life. So that would turn into a $20,850 income per year for life. And this is based on guaranteed values. We've also got hypothetical values that we look at, and that's based on the performance of the indices. And so in those, that matters for your death benefit. So you'll see here, you've got a different death benefit because they credited 0 right here. So there's 0 credited interest because in the worst case scenario, you might get 0 for several years in a row. Not likely, but it could happen. So your death benefit in that case after 5 years would be $188,000. That's after you've also been paid $20,000 for your income. And I get asked this a lot. So, what happens if I have joint income and let's say I turn it on and I pass away? Then the second person on that annuity contract would just keep receiving the exact same income for the rest of their life. Let's say you have a single annuity, not joint, and 2 months in after you've been paid your monthly income, you pass away. Well, then your beneficiary receives your contract value as a death benefit. And then that's going to be tax dependent on whether you put qualified money into the plan or non-qualified money into the plan. And we can break all of that down when we talk. I just wanted to give you a walkthrough of what it would look like to put $200,000 into an annuity and compare it to how different it would be if you were pulling from a qualified plan. And so another thing that I want to point out here, you see how there is one of these annuities that says enhanced payments. What that means is that if you were to have a medical situation where you needed to have long-term care coverage, then your income doubles. So this one in particular, this is Delaware Life, True Path Income. Right now, they have an income doubler, and they will pay that for 5 years to help you cover the costs of long-term care needs. So there are a lot of options, as you can see. One more important thing I want to point out is that when you're working with me as a client, I always use A- or better rated companies. That way you know that your income is safe and protected. Sometimes I'll hear that objection from people, well, what if the insurance company folds or goes bankrupt? Well, yes, that's possible, yet I use A-rated companies that have stood the test of time, and that would be very unlikely to happen. It would have to be an apocalyptic type event, which you'd be very worried about other things, not just your annuity. I know that's bleak and dark to think about, but I do get that question sometimes, so I just want to point that out. Something that's really important to know is that insurance companies are regulated by the state, and they are required to maintain cash reserves for future claims. Whereas when you put your money in a bank, they are a fractional reserve, which means that they only have a portion of your money in the bank, but can take the rest of your money and use it to make money in other areas. So in many ways, when you put your money into an A-rated insurance company, you have more protection. And another layer of protection similar to the FDIC for banks is that every state has a guarantee association that provides an additional layer of protection between $250,000 and $500,000 per policyholder per insurer. So you have several layers of protection. So I wanted to point that out because I get asked that quite a lot about annuities and insurance companies. So that was a brief overview of how I use software to help you find the best annuity that fits your unique needs. And recapping today, most people don't understand annuities, even though more retirees are choosing them for stability in 2025. An annuity is an insurance contract. This turns your savings into guaranteed income, often for life. There are fixed and fixed index annuities, so you can grow your money safely with no market risk. The fees are going to vary. Many have no fees unless you add income riders, which can provide lifetime income. And annuities will help you build your income floor so you can cover essential expenses with money that you can count on. If you're ready to explore how annuities could fit into your plan, go to retirementincome.school. You'll find a button at the top of the page that says book a retirement income Q&A call. You will get to have a meeting with me where we will talk about your unique financial situation, and then we'll run through the software. We'll look at your Social Security income. We'll do a whole bunch of different steps to look at what you have to meet your income floor and how we can fill the gap using different solutions that I have available, one of them being annuities. And then if we decide to work together, we will implement the plan and monitor it every 6 months, making sure that you are on the right track to be able to relax in your retirement. Thanks again for being here for another lesson. If you haven't yet subscribed to the Retirement Income School, be sure to do so on YouTube and the podcast. Click on the notifications so you never miss out, and continue to stick with me here at the Retirement Income School, where you will learn to keep your money safe and make it last so you can enjoy retirement. This content is for educational purposes only and is not financial, legal, or tax advice. Always consult a qualified professional before making decisions about your retirement.